Today, I'm going to tell you exactly why you will never make money in the stock market. And I'm really going to break down this one reason here. Now, you might be watching this and go, well, I don't do this. Then great for you. However, if you do this, or if you're thinking about investing in the stock market, then it's very likely that you will fail to outperform the markets if you fall for this exact reason. Now, you have the typical investor that goes, well, I think actually, we haven't had a recession yet, but I can forecast it, and a recession is coming. Therefore, I'm just going to wait, and I'm going to hold cash. I'm not going to invest, and I'm going to wait to buy the dip because I know exactly when to put my money in the markets. You get the point. You got this investor that's saying, you know what, look, it's not a recession yet, but I'll wait for the recession and I'll buy the market right at the bottom, right? And it sounds very, very easy, right? Just buy low, sell high. It's a very simple premise or idea at first. However, when you really dive into it as an investor, you realize, hang on, how wrong you could possibly be. And there's a few reasons for this. Firstly, the economy and the stock market are not the same. The economy can decline 10% in GDP for whatever country or wherever you're on about, but the stock market can increase 20, 30, 40%. Typically, the economy and the stock market do have a similar overall long-term trend in terms of direction. However, realistically, they're never truly the same. And when we were during the pandemic, where we were completely shut down in lockdowns, for instance, you would have seen a prime example of where stock market valuations were really soaring up and the economy was still shut down. It was completely detached. The stock market was completely detached from the economy itself. And it's one of those key ideas. Furthermore, if the typical investor, right, the average investor underperforms, and at the moment the average investor believes there's likely going to be a recession in the next 12 months. Whether they're right or wrong, that does not matter. But this person going, you know what, I'm going to wait and see wait for the recession to actually happen is stupid. Now, you need to really think about this, and there is a true reason for their stupidity because you can't forecast this. If everyone anticipates a recession, people are going to try and position themselves accordingly, right? So they're going to use that and they're going to go, okay, you know what, look, I think a recession's coming in the next 12 or 15 months. I'm going to start selling down some of my stocks and wait for the crash to buy again. If they do that as well, sometimes they'll be smart, sometimes they'll get it right and they'll look like an absolute genius. Sometimes they won't do that and they'll look like an absolute idiot like myself, because quite frankly I'm down 50% at the moment and obviously I didn't sell, so therefore I'm an idiot and therefore you should probably disregard this. But if there's one thing I'm very, very good at, it's losing money, and therefore if I've lost 50%, just do exactly what I don't do and you'll make money. Therefore surely I would know the secret to money making because I could just do the opposite of what I do myself, right? Now, don't take that as financial advice because quite frankly it is not. But again, the stock market and the economy are so detached. The idea of going, oh well, I'll just buy the dip in the recession, okay, smart guy. When exactly is this recession? Are you telling me we're going to have a recession in 6 months, 9 months, 12 months? Okay, when's the stock market going to be at the bottom? You're likely not going to be able to tell me this, but you might go and give it a punt. You might be an analyst that's going, you know what, I think the market's going to bottom in exactly 157 days. Now, you could be right, you could be wrong, and the ones that are right, the ones that give the bold guesses and do get it correct, obviously they'll get the attention of the media and you will hear their names. However, you will not hear the names of the ones that don't do that, the ones that got it wrong, because quite frankly, they're forgotten about and they'll keep making these outlandish forecasts. A great example is cryptocurrencies, more specifically Bitcoin. Now, there were loads of people on Twitter saying last year that Bitcoin was going to be $100,000 by the end of 2021. How wrong were they? Furthermore, you have these same kinds of people going, well, you can just use this stock to flow chart, a big fucking staircase basically, and this means that it's going to be worth $1 million in like 10 years. What a load of rubbish. Using a stupid chart to estimate where it's going to be in the future. You could flip that chart or mirror it and it's going to give you a similar trend just in the opposite direction. What does that chart really tell you? Now, that's not to say technical analysis on a short-term basis using the idea of what's buying and selling and keeping an eye on the level 2 monitor isn't an effective method of obviously purchasing a stock. And the same reason applies here on moving averages, because obviously the trend is your friend, but at the same time, to predict it in such a ridiculous kind of staircase motion is utterly rubbish. But you get these kind of outlandish predictions and they hit the news. The news loves it because guess what? They predicted exactly when the recession was. Now they're going to get loads of coverage on CNBC or wherever. Now these people, you think, well, okay, well, if they've done it, I can do it too. And this falsely encourages a bunch of investors thinking, well, okay, if he could predict exactly when the housing financial crisis was, or if he managed to short it, then surely I could do the same. This is how I can make money. And realistically, I don't think that is a sustainable way of making money, because it's just a glorified gamble. Now, don't get me wrong, you can do your research and you can go, you know what, I've been looking at the economic data, I've been looking at qualitative and quantitative data, meaning you've been going around to stores, you've been seeing a lack of footfall, but you've also been running the numbers of public companies and seeing, you know what, all of this is declining. Therefore, I think a recession is on the way. But again, it's hard to it's hard to picture the stock market following that economic trend. Now, that data could be publicly available and the stock market may just stay stagnant for the next year. You don't know this, but the act of selling or holding loads of cash that you can therefore buy the dip at the bottom is absolute rubbish, because you're not going to get the bottom. And what will happen is you'll see the stock market drop by 10 or 15%, and this same individual that's going, well, I'm just going to buy the dip at the bottom, is just going to wait another 10 or 15%. They're just going to get greedier and greedier. So what ends up happening, and not in the good kind of greed either, it's not be greedy when others are fearful and fearful when others are greedy. It's just being greedy whilst others are fearful, but being so greedy that you don't buy anything to your name, not even a Freddo for probably about £2 nowadays. They are quite expensive in the UK. Inflation, am I right? Regardless, using that, you're not going to be able to buy the bottom, because this same individual, as I say, is going to see this stock, let's say Boohoo, right? Boohoo dropped by 50% from £4 a share to £2 a share. Now it's dropped a further 75% from £2 a share to 50 pence a share. Now, obviously, that would reflect some serious issues in the company, but this person might be going, well, I would have bought this stock at £2 or £1.90. And when it hits £2, they're like, well, actually, no, I'll buy the stock at £1.10. And when it hits £1, they're like, well, actually, no, I'll buy a stock at 50 pence. In fact, these are the kind of idiots that will be buying the stock as it's already gone up. Because, yes, and don't get me wrong, there is a strategy to this, and obviously sticking with the trend. But these are the same people that will go, okay, you know what, look, I don't know what I'm doing. Well, they won't say that, obviously. But what they'll do is they'll purchase this stock, and it'll be on the way up. And they'll buy it after it's already had a 30 or 40% rally. And at that point, you don't really know. Is it underneath its fundamental underlying value? Well, they don't know this because they're buying based on a share price on a chart. What are they doing? Now, again, this is not to say you can't swing trade. This is not to say you can't day trade, but a majority of day traders lose money. So it is certainly food for thought. But it's just a prime example of why you will likely lose money when you do things as bold as this. Now, a typical strategy that does work over the longer term is buying just broad-based index funds that track the entire world economy or the world stock markets, such as a FTSE All-World Fund. Now, these funds are quite good because you can effectively replicate the entire world economy. And if the entire world stock market there, and see, I nearly fell for my own trap, you can replicate the entire global stock market. And if that stock market is down by a significant amount, then there's likely some massive issues that you probably have to worry about, like some form of nuclear warfare, at which point the last thing you're going to be thinking about is, how can I cash out my Vanguard fund because I'm about to get blown up by a nuke or I've got to go sit. You're just not going to be thinking about that, are you? Quite frankly, you're probably going to be going, where's my family? I don't have a family. Okay, I'm probably going to do something stupid because the world's about to end. You get the idea here. The only issue with these all-world funds is that you can't truly beat the stock market's performance by replicating it. You will never beat that once you include fees as well. You're always going to be underperforming the global stock markets marginally. But an average annual return of the S&P 500, which is not global, but the companies inside it are obviously, that's about 8% per year over a 30-year period. Now that's a pretty respectable return, and you don't have to worry about any of this rubbish about trying to buy the top and sell the bottom. I know I said that the wrong way around, but that's effectively what might happen in a lot of individuals' cases. Now, if you were able to predict the bottom of a crash 3 times in a row, then you would have enough money to be a billionaire. However, how many billionaires are in this world? Not many at all. So clearly there is no secure method to this method of, or this strategy of making money. Thank you for watching. Have a fantastic day.